So income plan, and for most people after they've squared away their income plan, when they have excess assets, hey, now we can invest for growth. Now we can accept volatility. We can embrace the stock market because you have time on your side because you're not relying on that money for your lifestyle, right? And when it comes to investing, these are the two most important things I think you should think about. What is my risk capacity? So capacity is your ability to sustain losses without it negatively impacting your lifestyle. So any advisor should be asking you questions like this, right? When do you begin to expect withdrawals on a regular basis? How much do you rely on income? And you can see, depending on your answers, there's a number score, right? So if you're starting right away, you have a 0, right? But if you have time and you're not relying on income, it's going to give you a higher score. The higher score is going to give you what? A higher suggested risk allocation, right? I've talked to, I don't know, let's say 1,000, hundreds of people like yourself, right? And many people, where you want to be is you want to have a higher risk capacity than your risk tolerance, right? Where people go array, and we've seen problems and plans not work out, is when they have a low capacity, but their money is working for them in a way where they're like, hey, I don't mind the roller coaster. I can hang in there. But they didn't have the capacity to sustain the downturns for a sustained period of time. So the capacity is your ability, right? So that's a logical perspective. And your risk tolerance is all about your emotions and how comfortable you are, right? Do you open that statement every month, and if it's lower, you get freaked out, right? So ask yourself, if the market goes down, right, 25% overnight in a short period of time, how are you going to react? It's just, if it's down more over a longer period of time, what are you going to do? Are you going to go to cash and say, hey, I can't afford to take any more losses? Are you going to hang in there? Or are you going to add money to your account to take advantage of lower prices? I'm not going to put any of you on the spot. You don't have to answer. But think about those things. If the answer is one of the first two, I'm going to go to cash or I'm going to move to things that are more conservative, you may want to reassess your investment plan because you are short-circuiting the process. You're making it harder on yourself to be successful. The reason why equities deliver a higher expected performance over time is because of the volatility, right? So you have to ask yourself, is that appropriate for me at this point in my life? Maybe the answer was yes during your working and accumulation years, but maybe not so much during your retirement years, right? And there's nothing wrong. Most plans are going to have a balance, right? And that's the key. Just like we had these different tools and these different golf clubs, you need a combination, right? You want access to different tools at different times. Most important thing in this area, I think you need to be aware of, because the financial world is changing, has changed, right? Traditional equity investment portfolio was stocks and bonds, and you vary the percentages based on your age, your risk tolerance, right? The problem is bonds are greatly impacted by interest rate movements, right? And they dramatically benefit when interest rates decline, right? The opposite happens when interest rates increase. So you can lose money with your bonds or bond investments when interest rates rise. Did you guys know that? A few of you? No? Okay. Very important, right? Interest rates. So you got to be careful, right? They say in the investment world, past performance is not indicative of future results, right? But people always say, how has it been doing? Right? So we have to, we understand, we want to know both things, but just because a bond portfolio did very well the last 4 or 5 years does not mean it's going to do well the next 4 or 5 years. It did very well in the last 4 or 5 years because interest rates decline. So what's your outlook? Do you believe interest rates are going to go negative in the United States of America? You might want to, then you might like to be allocated to bonds. If you think, not likely to happen, might cycle higher, I'd be very cautious with that. Right? If you're doing things yourself, if you're working with an advisor, what tools do they have access to? Are they doing things the old way or the new way, right? I have, I'm sure you do too, right? I have a nice, kind of like a computer, but phone, computer, right? There are some people that at their home, they only have this, and there are other people where they still have the rotary phone that plugs in the wall, right? Is it good or bad? Well, if all you want to do is talk to someone, they both do that, right? But if you might want some other tools, right? So you can text, right? You can check the internet or Google Maps or, right? Well, the investment world is the same thing. So if you just want to use stocks, bonds, and cash, it may work out. It's like that rotary phone. It's like that tube television, right? You may want to embrace technology like we have in so many other areas, right? Healthcare, technology, right? So as the world changes, it's your choice. If you want to change with it, and would that be better for you? And then the big question is, in what way, right? So these are different financial tools. I've worked with all of them over the years. Right now, I'd say for the past couple of years, and looking forward, I believe this is the optimal mix in some capacity of, so the blue is traditional stock market stuff. You can do really well when things are going well, and you lose when things are going bad, right? And then the purple or the pink is that green line that I showed you, right? That index insurance where you get some of the gains in good times and none of the losses in bad times. And then the orange is what we call structured notes. I've been working with them for about 6 years. It's a sophisticated product. They're not available to consumers. They're distributed through advisors, right? So if you're not working with an advisor, you don't have access to them typically. And most advisors don't know how to use them, right? Because they may not have embraced the different tools, right? So I'm not doing this to promote myself primarily. It's to educate you and to understand somebody is always going to be making money off your money, right? Where your money is, a bank, a brokerage, right? But the question is, what are you getting out of the deal? That's the most important question, right? Because I believe that you should come first, right? The company should profit in service to you, not at the expense of you, right? And I don't think that that's the case in general in my industry. So it's a great privilege to be able to get up here and try to share that message and spread more of that message, right? And then hopefully you can take it and implement it to whatever ways helpful for you, and then share that message and so forth. So these are some of the common challenges that I kind of touched on a few of them already. Different companies, different advisors, stocks and bonds, right? Volatility, right? In March they went down 35%, and then over the next, they're doing great, right? So it's an interesting time because a lot of people have more money than they've ever had, right? Because of the stock market and real estate markets, what they've done, and because they're not able to do all the traveling and the trips that they normally would do, right? So they're spending less, saving, what value, if any, are you getting from your other options? Because some people will say, oh, well, the value of the bonds is there a buffer against stock market volatility. I don't think, right? And they're not wrong. I just think there are other tools that will accomplish the same thing, but give you a better return, right? And maybe even a better buffer, right? Because a no-loss guarantee is better than a bonds which they don't have the no-loss guarantee, and you should expect to lose money if interest rates rise, right? On that holdings, right? So active and passive, when you're talking about your stocks, that's a whole other conversation. I'm not going to get into it. I'm starting to fall a little bit behind, so I'm going to pick it up. Things you can do yourself and understand that there are some things that you're not able to do yourself, and it may be worthwhile to engage a professional at a cost to you, right? And some of those things you can have a professional help you with at no cost to you, right? Investments are different than insurance, right? We'll talk a little bit, Medicare is step number 6. There's a lot of great Medicare services and people that can help you with Medicare decisions, and I'll share with you my perspective and the way I look at that a little bit. Hey, Adam Goodman here. Hope you enjoy the content. Got any questions? Feel free to reach out.